Hey guys, welcome to our channel. Today in this video we will talk about what is tax management and how it works. Tax can be a major impact on long-term growth of a portfolio. Find out how many countries thoughtfully tax management can help investors maximize their wealth. What should investor know about tax? First, let's review some of the key features of the US tax code that influence good tax management practices. Taxable event. Investor uh, investors get a tax bill only if they sell a security for more than they paid for it. The tax is applied to the difference and owned in the tax year of the sale. Unrealized gains are not subject to tax. Tax rate uh, differential. Securities sold less than a year after purchase are taxed at a higher rate than those held for longer than a year. Treatment of losses. If investors sell a security at a loss, uh, get do not get a check for the IRS, but they can use the loss to offset capital gains elsewhere in their holding. Any excessive losses can be carry over future years. So next is although these rules are subject to change, they are endured uh, our time and act in concert. uh, that is, even if one of them were to involve there uh, usually still plenty of value to tax management given to others. So what does tax management involve? Tax management means being careful about realizing gain and strategic about realizing losses. There are four primary techniques: holding security long enough to qualify for a lower tax rate, selecting loss, minimizing and gain, minimizing tax lots of traders, moving securities in or out of a portfolio in kind instead of liquidity, and avoiding purchases that would disallow losses according to IRS was sale uh, rules. None of this is quite as exciting as trying to predict where the price of oil is going or which tech stock will be the next being big thing. But being savvy about the tax consequences of trading can help preserve wealth in a portfolio. This gives investor more dollar to put to work in the market and can rely add up over the long run. Third party research has shown that tax management can add $1, $2 in after tax excess returns. These techniques are available to any investor, but of for many they are an other thought addressed maybe once a year. So how does tax management work? In a direct indexing portfolio, investor get a core market exposure with an express focus on taxes. This portfolio is not just inherently tax efficient, it can produce excessive losses that can then be used to offset gain elsewhere in the investor's overall holding.